Welcome. I'm Catherine Magana here with Rachel Ivanovich, Vince Stefano, and Greg Carroll, where we're here to provide you insights on the markets, tax planning, and much more. Today is July 9th, and here we are. We have the U.S.-Iran conflict is back at it. We have the AI seems to be doing very well again, at least this as of this morning. But the big news of the week is we have Vince Stefano back from an African safari.
It's good to be back at the table.
You didn't get eaten. Good news.
I stayed in the car.
Smart man.
Yeah, I didn't jump on. No, it's good to be back at the table, guys.
Yeah. So it sounds like you had a nice little birthday
It was wonderful.
getaway.
No, it was an epic trip.
Very nice. So over the last week, as of yesterday's close, yesterday was July 8th, we didn't have too much market movement over the last week, believe it or not, considering the markets were down yesterday. But the Dow Jones year-to-date is at 8.92, the NASDAQ at 11.31, which is slightly down from last week, the S&P 500, 9.31, which is pretty much flat, and the Russell 2000 at 19.12, which was down a little over 2% from last week. But for the most part, we didn't see too much movement. I know Friday was, the office was closed for the 4th of July holiday and weekend. But looking kind of at where we're at this last week, there wasn't too much market movement. Looking at where we're at with kind of interest rates, so the one-year CD right now is at 4.15, and the one-year Treasury bond is at 4.13, but the 10-year Treasury right now is at 4.54. Got a little tongue-tied, and so that is that's actually come up a little bit recently. Then we have kind of looking at the Fed rate cuts and what the probabilities are for that. So the next meeting isn't until later this month, towards the end of July, and there is about a 74% chance of no change and a 26% chance of a hike rate. And then looking at kind of the probability for the rest of the year between now and the end of the year, there's a 57 to 85% probability of at least one interest rate hike by the Fed. So once again, that could change between now and then, but I do think at the next meeting, potentially we won't see any major changes there. Looking at mortgage rates over the last week, so the 30-year rate was at 6.56, so that was up slightly from last week. And the 15-year mortgage rate right now is at 5.83, and that's slightly down from last week. So those they've been pretty consistent, though, in those ranges over the last several months. And then kind of looking at kind of where we're at with kind of the fear and greed, which I was looking at this morning, which is going to surprise you guys. So right now,
it usually surprises.
So as of this morning, July 9th, we are at neutral. So we're at at 47.
That's surprising. That's very
surprising.
Last week we were at fear at 31, and once again, the markets, even though they fluctuated. And they didn't really fluctuate too much in the last week. We're pretty much where we were last week.
Well, didn't you say we were at like extreme fear earlier in the day from fear last week?
We did hit extreme fear at one point.
Yeah.
So there's definitely been some movement there.
It's as volatile as the market.
Yeah. So that's kind of where we're at. It seems like the markets are still in positive territory for the year. We are starting to see earnings come out. I know there was one that just came out this morning, but we're going to start seeing that come out probably for the next several weeks.
I'm going to comment a little bit on the volatility. Mm-hmm. You had mentioned that fear and greed index and how it's neutral right now and how it's jumped a lot. And I think part of that is, you start seeing market volatility, and there are a number of reasons. One, markets have hit new highs. Number two, we were at the end of the second quarter, and you get a lot of portfolio tweaking, around the end of the quarter by institutions and hedge funds. You've seen a big rotation over the last 3 to 4 weeks where you had the semi-cap equipment companies and the chip makers have a sizable sell-off, and managers started rotating into other sectors and subsectors, i.e., all of a sudden software stocks started rallying on the fact that their valuations look very good. You saw a lot of attempting to position for Q3 and what it's going to look like. And you had mentioned the Iran war. Well, I think a lot of what happened was I think they thought a deal was going to happen. And so the markets
every
were
other day.
Yeah, every other day. It looked like the deal was going to, ferment and do well. And then oil prices were coming down, and they came down, I think, from over $100 a barrel. They were down into the 60s at one time. And so you had not only overall inflation, but you had energy price inflation coming down. The markets reacted very favorable to that. And then all of a sudden the shooting starts again. Yeah. And unless oil gets back into the 80 to 90 range, that's when it's going to be a headwind for the market. So until then, I think we're going to be okay.
Do you think the market's pricing that in? Because I feel like yesterday the markets were down, but it didn't end up at the end of the day. We didn't end up as down as much as
I don't know, because today I thought it was going to be down, and I've been shocked at how all of a sudden they're rallying it and that's rallied the chip market. But also, you look at, you'd mentioned AI, or maybe you mentioned AI. I don't know. Somebody mentioned it.
I think that was
Catherine mentioned AI. There's been a slowing of the AI trade a little bit. The momentum is kind of
got a little exhausted.
Yeah, the near-term momentum is exhausting, but the long-term is still there, very favorable. But, people are looking at return on investment versus potential overcapacity, elevated expectations, and the fact that a lot of these hyperscalers are now looking to raise large amounts of capital to fund their expansion. So I think near term there's volatility, but long term I think there's still a huge opportunity in the AI
I think
trade.
what you said there is raising the capital. They're going to the bond market to raise capital, where they have such massive amounts of cash flows over the last many years that it was kind of shocking that they actually had to borrow money to continue this build out. So I think that really got a lot of participants pausing, saying, "Whoa, where's the payoff to all this?"
Yeah, you're right, and I think that's kind of spooked the AI trade a little bit. Yeah. So, we'll see what happens. I think long term, I think it's still a terrific opportunity for investors.
Just another kind of a way to protect yourself a little bit from some of the volatility out there. I know, we've got the Iran war on and off again. You've got the market at all-time highs. You've got a midterm election coming up. Oil prices are up. Gas prices are up. That doesn't bode well for the current administration. So there's, a lot of going to be even more volatility, I think. And one of the things that we do to help mitigate some of that volatility is ETFs, defined outcome ETFs, where you can actually define over a given period, define your risk, your top side, your upside cap, and give yourself a cushion on the downside, anywhere from 10% all the way to 100% protection over a given time frame. So there's a lot of different ones out there. They can go from 1 year, 6 months, all the way down to quarterly. And you can actually, they have dual directional ones now, where you can actually, instead of the 15% buffer or cushion on the downside, you can actually profit from that. All the way down to minus 15, you actually get the absolute return. So if it's down 10, you make 10. It lowers your upside cap a little bit on the upside if the market's moving, but depending on your risk tolerance, it's a nice way to feel a little bit more comfortable about being in the market with some protection. So if anybody's interested in that, give us a call and we can.
So that would kind of tie into their kind of investment proposal and strategy, and this is a part of it.
That's a piece of it. Yes.
Great. Well, I think kind of over the last week or so, we've had a lot of conversations with clients. And one of the things that came up earlier this week was Rachel and I met with a client that unfortunately, her mom passed away recently. And so she is overseeing the assets of the trust in the home. And they're starting to distribute some of the assets based on the wishes of the trust and the mother. However, once that's done, one of the conversations we were having with her is the intent with some of the money was actually supposed to go to the grandkids, or her son and her sister's kids. And so she is now going to give some of these grandkids part of her money because she knows that was the intent of some of those assets. And so while it wasn't in writing in the trust, here she is, in her heart says, I want to do this because I know that's what the wishes are. And so give her a lot of credit that's, to do that and honor that when she didn't have to. So that's, once again, why it's important that if you have a trust, you want to make sure everything's detailed and lined out so that you know exactly who gets what. But the thing with this is when she does do this, then there's the tax part of that with, I don't know if you want to share.
So depending on how your assets are titled and what kind of a trust they're in, they could potentially get a step up in basis or not. And so there have been situations where the step up in basis has been questioned. And so you definitely want to be working with the estate planning attorney to determine ahead of time what is the tax impact on it. Because if, for instance, if you hold stock or real estate in an irrevocable trust and your heirs will not get the stepped up basis and will end up having to pay tax on those assets. If it's held in a living trust, on the other hand, and then it becomes irrevocable upon the person passing, and so then because it was in a living trust, it does get the step up in basis. So just planning ahead and really knowing, I think it's really important. But for instance, I had a client who, and making sure you go through all the steps.
But before you move on with that is, so when she gets the money, her portion, and then when she gifts it, then she can do that, but now she has to do the gift tax
Yes,
return.
correct. So she's the beneficiary of the assets per the trust documents, but then when she actually fulfills the wishes, she has to file a gift tax return.
Oh,
For herself.
For herself, because she's the one giving the money.
Wow.
So you have to walk all the way through the process to make sure you're not missing any steps.
you know, I've had family members, friends, clients going through this situation without the proper wills in place, and every time it's a fiasco. So
It just costs a lot of money.
time.
it
and
causes problem amongst the
Beneficiaries.
beneficiaries. It costs a lot of money. It takes time. It's just so important to have your assets titled properly.
And not
before.
only that, but what I was going to say was I have a client who went through the steps but then failed to get everything notarized.
Oh, yeah.
And so then after she passed, the documents were invalid. And so they had to go.
They're invalid?
They weren't notarized.
Wow.
I mean, can't you write a will on your napkin and say, "That's what I want"?
This is what I want to do.
I guess not
I mean,
in the
there's
state
some
of,
direction there.
I
but-
guess not in the state of California, but they had to go
Yeah.
before a judge and say, okay, this is what she drew up, but she didn't get it notarized. They ended up honoring it,
Yeah.
but they did have to go through those extra steps and pay
Extra
extra
steps.
money, et cetera. And so just make sure that you're actually taking the steps, but then actually going and getting it notarized as well.
Yes.
And making sure things are titled properly, which we've
Correct.
talked about in the past.
Yes.
Because it
Yeah.
blows me away how many times we have
It's
a
in
new
the
client or a
trust.
prospective client. They're like, well, no, here's my trust, and it's in the trust, but the asset isn't titled in the trust. And you realize, oh, no, that's not in the trust.
I brought in a client recently too, and it's, the two sons were the trustees, but mom's still listed as a trustee on the accounts, and she gave it up a couple years ago, but the account, wherever it was not titled properly. So, that's just going to create more of a problem. They'll probably figure it out if something bad would have happened. But yeah, there's a lot of things that people don't really realize they need to update
Exactly.
when things change like that.
So during the summer and throughout the year, people make big decisions, sell properties, leave, decide to retire, and so on. So I've actually had several clients and potential clients reach out because they were at the point where they were deciding, okay, it's time to retire, and I have my big 401k. What shall I do with it? And so we were able to explore the idea. Again, we've talked about this before on the podcast, but we explored the idea of what's called NUA, which is Net Unrealized Appreciation. And so I just want to talk really high level about this because I have had several clients reach out recently. So NUA is a special tax rule that allows you as the employee to pay capital gains tax instead of ordinary income tax on the appreciation of the company's stock that's held inside a qualified retirement plan. And it only applies to employer stock, so maybe you have an ESOP or company stock inside a 401k or a profit sharing plan or some sort of employer plan. And for the right person, it can save you tens or even hundreds of thousands of dollars. if you do this correctly. So it's not for everybody, but let's just give a simple example. So let's say that you bought company stock inside your 401k or other retirement plan for $100,000, and years later, now it's worth $500,000. So normally what would happen is you would roll that entire 401k into an IRA when you retired, and every dollar that you took out of that would eventually be taxed as ordinary income, so whatever your tax rate is. With the NUA, the difference between what it's worth, 500, and the 100,000, what you paid for it, that 400,000 of appreciation, it might qualify for long-term capital gains treatment instead. So for the right person, it really can make sense. So just a couple of bullet points on when is it worth considering. So let's just say you're leaving your employer and either you're retiring or you're over 55 and you're separating from service. A significant portion of that 401k is invested in your company stock. So you're leaving and part of your 401k is in company stock. The stock has appreciated significantly. So if you have stock and it hasn't significantly appreciated, don't even think about it. Also, you're going to be in a high tax bracket when you retire. And make sure, there's a lot of shifting pieces when you move into retirement, so you want to make sure you're consulting with advisors. And then you have a long-term plan to sell the shares. So you're not going to retire and immediately sell the shares. So those are some of the bullet points of when it makes sense for you to do this. But some common mistakes is that you roll everything into an IRA before you evaluate doing the NUA, because once you roll it into the IRA, you don't qualify for that anymore. The other mistake is that you sell the company stock inside the retirement plan. So you definitely want to consult with advisors. It's not for everyone, but if you do have highly appreciated company stock in your 401k or other retirement plan, it's a very valuable tax opportunity.
Does it matter if it's private or publicly traded stock?
I don't know the answer to that, but I can look it up.
I was just wondering.
That's a great question.
I was just wondering.
That's a good question. Don't know the answer.
But
next week.
Yeah,
Probably
Stay
not
tuned.
a lot of private stock inside most qualified plans.
I would think
so,
not, but you never know. If
I get
people,
there certainly could be,
I don't know.
Yeah.
That's why I was asking.
Yeah.
I mean, I can understand the publicly traded stock, but if you work for IBM or something, but doesn't
Stand
matter.
by for next week.
Couple things. I wanted to just throw this to my tax specialist. Everybody knows, well, maybe everybody doesn't, but Larry Kudlow, who has been a long-time economist on, a number of the financial networks, along with other economists, have been, talking about having the Congress, once they come back into session, since they're on their summer break right now, is to do a reconciliation package and look to cut the capital gains tax, not only for stocks, but also increase the exemption for real estate. And this is kind of interesting. They're talking about, for a married couple, take the exemption to $1 million, and for an individual up to $500,000. And they're saying that would not only free up because you're talking about the real estate markets a lot, it could free up a lot of housing and also free up.
That's a great idea.
Yeah, and also free up a lot of cash that people have sitting in their homes. So if that happens, that could be a real boon for the markets.
So you're referring to Section 121.
I don't know what that is, but I don't know what that is.
So I actually know someone who's been going and lobbying on this, because Section 121 is the section of the tax code that allows an individual to exclude up to $250,000 on the gain. $250,000 gain on the sale of a primary residence. So if you live in your home for 2 out of 5 years and you own the home for 2 out of 5 years, you can exclude up to $250,000. And it's never, as far as I know, been indexed for inflation. So the bumping it for an individual from $250,000 to $500,000 makes sense, and for a couple to $1 million, that would help out.
A lot of people aren't selling because they got such a low mortgage rate, but this would incentivize them, like you say, maybe to, all right, I can make up a tax-free gain.
I have plenty of clients I do projections for, and their home has appreciated so much, and they really want to downsize, but the taxes would just wipe it out.
Yeah.
And so they decided not to, because they want to take that money and buy another primary residence.
Right.
And so they're staying in the big house.
But it's not uncommon having those conversations, because there are some individuals or retirees that want to downsize. They want to move out of state to closer to their grandkids. I mean, there's
And
a
it
lot.
makes sense.
And so if this goes through, potentially that might change their view of if it makes
Oh,
sense for them.
absolutely.
That's a great idea.
So we'll
I like
see.
it.
I guess,
I
you know,
like
we never know. The bill
never know
comes
what's
out,
gonna
yeah.
happen.
But it's good to know, and we'll definitely keep our eye
And
on that.
lastly, the little tidbit of, right here, and anybody ever asked you this, but in 2025, last year, 2025, over 440,000 new millionaires were created in the United States as a result of the increasing stock market valuations. And we're talking 401ks, IRAs,
How
and
many?
things like that. 440,000 plus
New
new millionaires were minted in the United
Wow.
States. Yes.
That's a lot of money.
So, guys, I tell you, I always keep saying the stock market is the biggest creator of wealth that you can ever imagine.
Absolutely.
So, get in the big casino.
Well, Rachel and I just did a podcast on our Savvy series on FOMO, on fear of missing out. So
There you go.
that's what this is FOMO. But when we talked about
Yes.
being patient, and being disciplined,
Having a
and-
plan.
Yes, having a plan. But yes,
Yes.
along the way,
Don't get FOMO.
Yeah, but you potentially could have some of these emerging stocks that are in your strategy. So that being said, we are. We just finished mid-year, so if you want to do a mid-year review, if you want to bounce any ideas, we are having conversations now about some Roth conversions. We do have multiple conversations about relocating or downsizing, and so happy not only to evaluate your investments, but also if there's some strategies or other things you want us to review, we're happy to do so. So thank you for joining us today, and we'll see you next week.
Thank you.
Bye.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.